financial ratios. Before we proceed to the main learning outcomes, we will review my laws of financial ratios. The first law is X margin. X margin is X over revenue. Examples include net income margin, which is net income over revenue, gross profit margin, which is gross profit over revenue. Operating profit margin will be operating profit over revenue. Moving on to the second law, that's X turnover. X turnover is revenue over X. Examples include asset turnover. Asset turnover is revenue over assets. Account receivable turnover is revenue over account receivable. But we have two exceptions to the rule. The two exceptions to this rule include account payable turnover and inventory turnover. So that we are all on the same page on these exceptions to the rule, let's look at this diagram. We have the suppliers here. Then we have raw materials, work in progress, and we have finished goods. Then your customer is here. Imagine you purchase goods on credit from your suppliers. That's credit purchases. As a result of the purchases, there will be accounts payable. Also, there is the cost of converting raw materials to work in progress to finished goods, and that is cost of goods sold. So that implies that when you are dealing with accounts payable turnover, it cannot be revenue. Account payables would go with purchases. When you are dealing with inventory turnover, it cannot be revenue. It will go with cost of goods sold. So account payable turnover is equal to purchases over account payables. Then inventory turnover is equals to cost of goods sold over inventory. Moving on, X to Y, or X per Y, or X on Y, all represent X over Y. Examples include earnings per share. Earnings per share will be earnings available to ordinary shareholders all over the weighted average number of outstanding common shares. Debt to equity ratio will be debt over equity. Return on equity, that will be return. Return is net income or earnings over equity. Still moving on, X coverage is equal to earnings just before X is being paid all over X. So that we are all on the same page, let us look at this example. Interest coverage will be the earnings just before interest is being paid, which is EBIT over interest paid. So that we are all on the same page, let us look at this income statement. Just a portion of the income statement. This is the interest expense. The earnings that we have just before the interest is being paid is EBIT, which is earnings before interest and tax. That implies that interest coverage will be EBIT over interest paid. Still moving on, fixed charge coverage. The two main fixed charges that most firms pay would be lease payment and interest payment. So if that is the case, we need earnings before these two. We have that of interest expense here. Still looking at this income statement. Lease payments is being deducted to arrive at EBIT. That implies that if we have to cover the two fixed charges, which are lease payment and interest expense, we can cover it with this, which I could call EBITL. That is earnings before interest, tax, and lease payment. But generally speaking, you won't see something of this nature in finance. So it's better to write it as EBIT plus lease payment. So lease payment plus EBIT is the earnings that we earn before the fixed charges. So fixed charge coverage will be lease payment plus EBIT all over the two fixed charges, which are lease payment and interest paid. Before I move on, it is worth noting that everything we have here is the same as net profit or net income plus taxes plus interest plus lease payment. Still moving on, X yield is equals to X over market price. Dividend yield is dividends over market price. Cash flow yield is cash flow over market price. Moving on to another law, and that is this. Current figures are used for items from the income statement, while average figures are used for balance sheet items. So that we are all on the same page, let us look at this example. Imagine we have 2017 figures and 2016 figures. The cost of goods sold in 2017, let's imagine it is 10 million. In 2016, let's assume it is 5 million. Let's also assume that inventory in 2017 is 2 million, but in 2016, let's assume it is 4 million. If you are asked to compute the inventory turnover ratio for 2017, the formula is cost of sales over inventory, but the cost of sales, since it is an item on the income statement, then you would make use of the figure directly, which is 10 million. But the inventory we have here is coming from the balance sheet. The balance sheet shows items at a particular point in time. That implies that we cannot make use of this figure directly. So what we would do is to find the average. So it will be this plus this divided by 2, and that will be 2 million plus 4 million divided by 2. We're able to make use of the cost of goods sold directly because it is an item on the income statement, and the income statement shows the performance of a firm over a period of time. So this 10 million is over a period of time. There is an exception to this rule here. To be more specific, an exception to the rule of finding average of items on the balance sheet, and that exception to the rule is liquidity ratios. Despite the fact that most of the items relating to liquidity ratios are derived from the balance sheet, we do not find the average of those items, and the major reason is because as far as the liquidity ratio is concerned, we're interested in the snapshot position of the firm at a given point in time. We are not interested in the position of the firm over a period of time. We're interested in the position of the firm at a given point in time.